Well, we do live in a mad world, and there are different ways to look at this. There are dark ways and comical ways and political ways and financial ways. Polarizing ways when it comes to politics, that's easy. Where I'm from in Europe now, I've been growing up in the States, many decades in Europe. We've seen Band-Aid coalition governments, finance ministers have no majority support from the people, but stay elected like Trudeau through coalitions until eventually they lose confidence. We've got a massive polarizing swing from the left to the right. You could call it the failure of progressive liberalism, the move to more conservative thinking. A lot of it's just because most of the people are broke. We've got a very polarizing election, and tomorrow when you're president of the United States, I don't need to speak about that. Could be sublime, could be ridiculous, we'll see. As Colonel McGregor was talking this morning, we also have military tragedies, hundreds and hundreds of thousands of dead in the Ukraine, what could be considered an avoidable war. That's very debatable, but nevertheless, we also have serious questions about whether Zelensky is George Washington 2.0 or Putin Hitlerized 2.0. I'm not going to solve that problem today, not going to talk about it, but it's certainly a tragedy. It's a tragedy in the Middle East. It's a tragedy that the red line in the South China Sea is getting fatter and we're actually considering a nuclear option. Probably not going to happen. It's mutually assured destruction, yet it's still madness. But all of these things are very polarizing, very debatable, certainly madness, but you want an example of something that I want to set off with to show how mad the world is. It's almost comical. And the example I came up with on my way over here, flying in from Europe, was I was thinking about this punk, Justin Sun, crypto millionaire. I don't know if you know the story, maybe you've read about it. There was an auction at Sotheby's for fine art. Modern art is a very questionable topic. We all have our tastes. But a 35-cent banana bought on a Manhattan street that morning was duct taped to a white wall at Sotheby's, and the auction began. And Justin Sun, this crypto genius, decided after fees to pay $6 million for a banana just to show the world that he could. Meanwhile, farmers in France, where I live, or the Netherlands, are committing suicide at the highest rates because the European commissioners who gather in Brussels just voted themselves a 15% pay raise despite being a layer of parasitic spending on Europe. The U.S., from Portland Square, Pioneer Square in Portland, 3rd Street Promenade to New York City, to Minnesota, the Midwest where I come from, the middle class is literally the working poor. And Justin Sun is buying a banana for $6 million and digesting it the same day just to show that he can. If you ever needed a comical indication of a late-stage empire or fourth turning, it's that crypto millionaire. But what does that have to do with gold? How can gold solve all of these problems? It can't. It can't solve human arrogance. It certainly can't solve all the political problems in the world. It can't save our central bankers or our politicians, left or right, from making promises that they certainly can't pay for without debasing the currency. But gold does have a rare. And I'll talk about what I've learned about gold from coming in the background as a risk asset guy in the 90s and the dot-com bubble in Wall Street and San Francisco during the first bubble. And I'll admit, this is shameless self-promotion. It's not even an attempt at modesty. I am a polo player. It's an obnoxious sport with obnoxious people. I admit it. Nevertheless, it's very addictive. I love the horses and the tactics far more than the people who are surrounding the sport. I've played it for years, but what have I learned? It's the same thing that Wayne Gretzky learned and said here in Canada. You never play where the puck lies, you play the direction of the puck. And in polo, when you're going 30 miles an hour down the pitch at full gallop and the player in front of you makes a gesture, as the ball's going this direction, a backswing is coming. If you're riding behind that player, you turn your horse before the swing. You see the direction of the ball and you change because it goes 180 degrees in the opposite direction. If you're playing correctly, if you see the direction of the ball, it's very easy to be effective in the sport, just like it is in soccer or hockey. And I'm seeing a direction with almost scary conviction about where the world is going and where the gold price is going and where the gold as a preservation asset and as a strategic reserve is going. It's not by talking my book. Like I said, I came up during the dot-com era as a stock bond jock in a very Fed-supported lottery ticket market for many years. It wasn't that hard. It was just a rising boat on a rising tide. But I am seeing a direction of the ball. I want to share it with you because whether you're investing in precious metal equities or direct physical metals, you need to not speculate, you need to have conviction. And again, what I've learned is conviction in the space, and it's based on seeing the direction of the various balls, about 6 or 7 balls that I want to share with you so that you have this conviction as you leave this room. Many of you probably had it when you entered. And the first ball is the most obvious ball. It leads to the discussion on gold, and that's the debt ball. This is the lie of omission that doesn't make the headlines as much as it should. It certainly wasn't discussed much in the polarizing debates of Labor and Tory or Republican and Democrat. We're looking at $400 trillion plus the next few years in global debt. Of course, the U.S., like Canada and many other countries, all the major countries of the world are drowning in debt. But in the U.S., its fiscal year starts in October. So already in October and November, the numbers have come out. We're running a $690 billion deficit in the first 2 years alone. When December comes, it'll probably be over $1 trillion. We're just not even into the first quarter of our new fiscal year. That's the kind of spending and deficit spending we saw during COVID. And currency adjusted, it's higher than the spending America did in World War II, when we were at full war, in a full emergency. So whether it was the COVID hysteria or the Second World War, we are spending, deficit spending, debt spending, higher than we were during a war. Like, it's a major crisis. But what's the crisis? Crisis is we're in debt over our skis at levels that are just abstractions. When you talk about 36 trillion in public debt or 100 trillion in combined household, public, and corporate debt, it sounds like I'm just showing off what I memorized. But these numbers are irrational. They're a banalization of debt. And that debt ball is no different in the home of the world reserve currency. And not just because I was born in the States, I'm focused in America. We're all affected by the dollar. We're all the dog being wagged by the tail of U.S. monetary and fiscal policy because it's home of the world reserve currency. And what have we got in the home of the world reserve currency since the Great Reagan to today? Well, 44 trillion increase in debt. Well, tax receipts are only up by 8x. There's a major imbalance. Our GDP is 1/3 of that. We're literally spending and borrowing and going into deficit at 3 times our income. Any corporation, family, frankly, or even individual would know that's unsustainable, and yet here we continue. As Neil Ferguson said, and as Colonel McGregor talked about this morning, the interest on our debt alone to pay Uncle Sam's IOUs is now greater than our military budget. And as anyone who studied history knows, it's ipso facto a sign of a dying empire. Probably more so than Justin Sun paying $6 million for a banana. But that's the first ball. It's debt. It is a debt collapse driven by sovereign debt, a crisis in the sovereign debt market. That's not an opinion. That's math and history. It never, not once, and without exception, ends well. The next ball is the economic ball. The economy, the recession we pretend does not exist in the US and certainly in Europe as well. What we have is what I call Wall Street socialism and Main Street feudalism. And I'm the benefit of this rigged system. I came out of grad school and went to Wall Street right away and benefited from a lottery ticket of a market which is entirely Pavlovian. We can get into all the wonky languages, derivatives, credit spreads, long-short strategies, different brilliant options plays by market dragon slayers, but it's very simple. Markets go up when the central bank is dovish and supportive, and markets go down when the central banks are cornered and hawkish. That's a gross simplification, but when you've got years and years of the Fed expanding its balance sheet by trillions, that goes directly into inflating the stock and bond market, which is why guys like me in their 20s were getting overpaid to basically sit there and ride the tide and pretend that that's intelligence. But I was there, I saw it, it was a lottery, we knew it. Hopefully we were humble enough to accept it. But meanwhile, on Main Street, we see a very different story. And this is the Main Street that I came from. And this is where there isn't support or socialism from the Fed. This is where it's every man and woman for themselves. And when my grandfather came out of World War II, the greatest generation, and worked at Ford in Detroit as an executive, the ratio of management to median employee salary was 15-1. In the 70s, by the time I was born, it was about 32-1. And by the time I got to the dot-com bubble and the Wall Street nonsense, it was 320-1. Again, I'm a capitalist. I'm all in favor of getting reward for your risk or your luck or your opportunity, but there's something pathological about that type of wealth inequality directly related to central bank policy. Now, in the case of Jeff Bezos, the ratio isn't 320 to 1 per median employee. It's 1.2 million to 1. Again, Amazon's a great company, Bezos is a great capitalist, whatever you think of it, but that seems almost not capitalism, that seems like feudalism. A land and a system is based on an extraordinary, historically unprecedented wealth inequality. Which leads us to another ball I'm tracking, besides the fake economy and the feudalism, it's the market. Again, the market is driven by central bank support, liquidity. Liquidity is the grease and the oil in the engine. As long as it's there, markets will rise. It has nothing to do with how intelligent you are at Wall Street, or what MBA program you came from, or what suit you wear, or what address you have in Manhattan. It's just being at the right place at the right time. It's been supported by the Fed for a generation. A generation that's forgotten what inflation really does, what debt really does, and doesn't really care. So stocks are scary. You can look at all types of indicators in all types of ways. I look at the S&P, the currency and issue, or you can look at the famous Buffett indicator, which is the market cap of the S&P relative to GDP. It's at all-time highs. It's over 200%. By just the forces of gravity alone, we will see the most ignored rule in Wall Street, which is mean reversion, but very weight of that bubble will eventually inevitably collapse when the Fed can no longer sustain this fiction. I can talk about the signals for that for a time afterwards. It's really not that hard. Meanwhile, in the bond market, the so-called risk-free return of the most important treasury bond or government bond in the world, for the last 5 years, when adjusted for inflation, gives you nothing. It gives you a negative return. It's return-free risk. And yet that's the U.S. Treasury, the U.S. 10-year, the Tier 1 asset the Bank of International Settlement asks you to go to for safety. Now, that market ball is followed by another ball, which we can all debate, inflation, deflation. It's not really a debate of either or. It's cyclical. They follow each other. There's all types of conversations now about what's causing inflation. Is it supply shocks? Will Trump's Department of Government Efficiency and layoffs lead to more inflation? Will mass deportation of immigrants be more inflationary? Will tariffs, of course, be more inflationary? We could argue this all day, and it certainly will be inflation, but the rule of cause of inflation is very simple. Inflation comes from debt. Debt is the thing that matters. And you pay for that debt when you don't get it through tax receipts and GDP, productivity, manufacturing. You get it by mouse-clicking zeros onto the balance sheet of the Fed and expanding the money supply. And the money supply has gone up 5 times in the last 20 years. That, ladies and gentlemen, is why we have inflation in the U.S. and why other central banks, again, the dog being wagged by the tail of the Fed, has a similar policy. We've had 60 rate cuts in the last year alone by central banks around the world. They're all desperately following the American lead. So when you have inflation, that leads to the next ball that we can see as we're running down that freaking polo field. And that's currency. Currency is a currency risk. When you add a bucket of water to a glass of wine, I've said this so many times, what does it do to the flavor of the wine? It dilutes it. When you add trillions and trillions of fake liquidity, mouse clipped out of thin air, to the central bank near you, it's the law of simple common sense that's going to eventually, over time, dilute the purchasing power of your currency. That inflation, that dilution, as you already feel, regardless of whether the CPI or the PMI or the PCE inflation measurements, which are pure fiction, and everyone on Wall Street knows that. But that inflation, that currency risk, is an invisible tax on you, the sucker for the criminal negligence of your central bankers and policymakers who habitually, chronically, pathologically overpromise and underdeliver, and whatever the delta is to what they promise and can't afford, they pay forward money created out of thin air. And guess what? The one who's paying for that is you. Because inflation is a compounding force. Never underestimate the power of compounding interest or compounding inflation. It is absolutely destructive. Everyone here, regardless of your income, knows this. This takes us to another ball, scarier ball perhaps, the geopolitical ball. Again, I can afford to be biased. I'm an American, very proud of it, but very embarrassed at the same time. Let's not kid ourselves about American foreign policy. We could spend an hour on each of these pictures. And I'm a patriot, and I come from a family of soldiers, but look, Again, I'll say about the military, they are lions being led by donkeys. So when I criticize American foreign policy, I'm not criticizing those in uniform. But look, Iraq, Libya, Syria, Ukraine, which of course is just an indirect war that the U.S. is waging, Afghanistan, Israel, etc. Freedom and democracy has not been spread there. We typically, as McGregor said, bully, come in, bribe, bomb, and then gently leave, leaving a wake of sorrow and death in our wake. And again, I could spend all day on geopolitical risk, but it's an undeniable problem. And what will happen when the Ukraine war ends is BlackRock will come in and build and make a fortune, just like Halliburton did after Iraq. And men I went to school with are still buried in the cemeteries outside of D.C., and I try to visit these once or twice a year. So, geopolitical risk is very real. But then we get to the ball that's probably the most important, the ball that I'm here to talk about, which is the golden ball. And gold is fascinating to me. I was listening to Frisbee and Alistair McLeod in Europe talking about gold, and Dave Frisbee had this. It's really fascinating how gold even came to be. It's interstellar collision of these rocks. It's older than our solar system. Yeah. It's been money since 500 years before the birth of Christ. In every major religion, Judaism, Islam, Christianity, gold and silver are discussed. They have metaphorical power, they have symbolic power. And do you know that in each one of our bodies here, that there's 0.2 milligrams of gold in your bloodstream? It's literally, viscerally a part of our natural lives. It is a natural asset. It is almost supernatural. And it's analog and not digital. That doesn't make it useless. It doesn't make it a pet rock. But look at what gold is telling us. Since we weaponized the US dollar in the wake of the Ukraine war, during the Ukraine war, to sanction Hitler 2.0 because we were saving democracy in Zelensky. Again, we can debate that all day long. But look what central bankers did. Because if you had money in Citibank and they froze your account, would you recommend Citibank to anyone? Probably not. John Maynard Keynes said, never weaponize a neutral reserve asset, a world reserve currency. Robert Griffin came to Congress in the 60s, said, don't go there. Even Barack Obama, don't weaponize the dollar. That was Biden's boss. I don't know who Biden was getting directions from or who was making decisions in the last 4 years, but it wasn't a very smart decision. In fact, it was one of the stupidest decisions in the 248-year history of our foreign policy. We weaponize that dollar, and what does the world do? It doesn't trust it anymore. It's a weaponized dollar. You've broken the trust. And what has the world done? They've looked at the dollar differently. They looked at the U.S. Treasury differently. It is no longer a safe Tier 1 asset. It is no longer a strategic reserve asset. And what is the world going to? Well, look at it. It's very simple. Before the war, central banks were buying about 118 tons. After the war, almost double that. Well, frankly, double that, 291 tons, and counting. Why? Because they like to stare at a pet rock because it's shiny? No, because it holds its purchasing power better than anything else. And no, central banks are not stacking crypto either. I'm not going to get into a debate about crypto. It has immense power right now. It's a wolf in sheep's clothing. Digitalization, tokenization means digital ID. Stablecoins, folks, is just central bank digital currency with another name. And that's coming. Nothing you can do about it. And you can profit off the trade. That's another conversation. But the world, the smart money, the central banks of the East, unlike Gordon Brown, who dumped all his gold, he thought it was a good way to make money, and the West won't tell you how much gold they really have. They're stacking gold for a reason. They see the direction of the polo ball. They've been stacking it since 2014. In fact, they've been net stacking it while they're dumping that other Tier 1 asset by the BIS, the U.S. Treasury. They prefer gold over the most important 10-year bond in the world. Why? Because they've lost trust, not only in a weaponized dollar, but they've lost trust in an IOU from an issuer that is literally quantifiably broke. And they don't trust it anymore. That's why we're stacking gold all over the world. And so, you look at the gold ball, oh, I gotta go backwards. You look at that graph on the Treasury, but some would say, gold's just too expensive. I missed it. It's overpriced. In a bull market, it's topping out. That is a complete fundamental misunderstanding of gold. It's a misunderstanding of inflation. It's a misunderstanding of price moves. It's a misunderstanding of history. Now, no one seems to mind. I'm not here to criticize crypto today, but crypto went to 100% in 60 days. It's $100,000 on its way to $100,000. Don't lose your mind. That's not astounding. Gold at $2,700 seems too expensive. Well, federal debt is up 4,000%. Gold's only up 226% since, 1980. 226%. We're wondering if it's too expensive. And free money supply is up 1,300%. The median house price in that same period is up 500%. Yet we're talking about gold at 26, 27 range being too expensive. We missed the boat. In fact, in inflation-adjusted terms, gold has to go over the 20% just to reach its 1980 highs. And when measured against the broad money supply, the M2, gold is as cheap today at 26, 2700 as it was in the 1970s at less than 50. So now you haven't missed the boat. Gold's not too expensive. And yet that's the talk. RAs, the Registered Investment Industrial Complex, Wall Street, where I come from, gold's too volatile. They don't talk about it because gold is an embarrassment to the system, the banking system, which is a grandchild of the Federal Bank, of the Federal Reserve, which is the twin brother of our government. They don't talk about gold because they don't want you to understand it. It's an embarrassment. Which brings me to and what I do. Obviously, I am a former hedge fund manager who figured out gold long after I've understood the corruption in the rigged internal system of stocks and bonds. And I'll be honest, my organization, Von Greyers, is not for everyone because our minimums are very high. We're very serious gold investors. For our vaults in Zurich and Singapore, the minimum is 400,000 Swiss francs. And for our James Bond bat cave in the Swiss Alps, which you have to see to believe, the minimums are 5 million. So it is for a different audience with a different bottom line and net worth, but what I have to say applies to anyone. Regardless of your income, you can all afford an ounce, a gram of gold, and you should. And when it comes to not just understanding why you should have gold, but we at Von Greyers understand very clearly is how you should own it. And one thing you should not do is keep it in the very banking system that we're trying to avoid the risk of. That includes paper gold, ETFs. This is the daisy chain of intermediary banks. If you want to hold gold to be free of the system, of the digitalized blockchain mutable ledgers that's coming, you've got to have your one real asset, physical gold, outside of that banking system. And you want to have it, I think, in a jurisdiction that actually sees gold as a protected asset and on a relative, not absolute basis, actually protects your privacy. Switzerland has some problems, but on a relative basis, there's no better jurisdiction in the world for that type of ticket, that type of purchase. Insurance matters, we're insured through Lloyd's. Logistics matter, being able to move that gold from anywhere in the world, whether you're buying or selling, whether you're in Australia or whether in Rhode Island. And of course, liquidity matters, and we have an in-house trading desk that gives you instant liquidity and wires in any currency you want to any bank account you want when you need it. But like central banks in the world, you save in gold and you spend in fiat. And then, of course, there's the service. Our team, two of us are former bankers. We know how the banking system works. We know how the sausage is made. Actually, 3 of us, of our partners, are former bankers. 4, when you really add it up. So it's not just why you should own gold, it's how you should own gold. And for the larger tickets, we're there, but you don't have to go to Switzerland with a $5 million minimum or a $400,000 minimum to figure out how to hold your physical gold outside of the banking system. Because gold is the direction, not just tomorrow, already yesterday and today. That backswing has started. The ball direction is obvious, whether it be the markets, the economy, the debt, the geopolitics, and the currencies, which are open and obvious. It's not even gold bugging, folks. It's just common sense. And I hope this gave you more conviction not to speculate in gold, but to believe in gold. Because it is a long-term asset. It holds its value better than anything in paper or on a digital ledger. And so I hope this was helpful to you. I thank you for your time.